All right. Good afternoon, everyone. It's Friday afternoon. For most of you, it already has been a long day, but bear with us. This is going to be a fun topic. I want to start with Jeff. Jeff, in the Netherlands, in Dutch, we say als een vis in het water. And it means that you're really in your element. And I think you're really in your element on this topic. So can you please give us a primer on what is capital structure? What are the dynamics between risk and reward? And can you also tell us something about seniority?
Yeah, absolutely. So welcome, everybody. All right, thanks for joining. And I'll give a quick overview of what's really happening with these Bitcoin Treasury companies and how they're structuring capital. So Bitcoin Treasury companies are holding, Bitcoin on their balance sheet, and they've got a large stack of Bitcoin on their balance sheet. And what they're able to do is structure tranches of risk that are senior in the capital structure that have different risk return metrics that are more appealing to different types of investors. So for example, strategy, they have equity, common stock equity, which is amplified Bitcoin. And then they have senior products on their balance sheet, Strike, Strife, Stride, Stretch, and now Stream in the EU. And each one of those different products, where they're positioned in the capital structure, has different seniority. And that different seniority creates a different mathematical risk function. And so when you're thinking about institutional capital and how institutional capital works, there's this concept in portfolio management called Markowitz modern portfolio theory. Markowitz modern portfolio theory is if you add a new asset to your portfolio that has different risk and return metrics, you improve the return and reduce the risk of your entire portfolio. So different Sharpe ratios, different risk ratios. And that's what these Bitcoin Treasury companies are able to do. They're able to, instead of just having a single commodity asset that's really volatile like Bitcoin, you're now creating different instruments that people can hold in a portfolio that have different volatility structures. So when you think about companies like insurance companies or pension funds, and they're looking for Bitcoin-like exposure, but they can't handle 50 volatility, they can buy these types of instruments, and they're appealing to these instruments are appealing to those different investors. So that's the real unlock of capital here, is creating products that are attractive to different capital pools, and that's what we're all trying to do. And that's where we're headed.
Yeah, thank you. Garry, can you tell us something about equity versus credit? And as an equity investor, where are they focused on? And a credit investor, what are they focused on? Can you explain the two? And can you also elaborate on where the preferred equity finds itself in between?
Yeah, absolutely. So my background is in credit. I used to be a fixed income portfolio manager and trader. Worked a few years at a bank for the credit derivatives trading desks. So my heart leans towards credit in general. Having said that, clearly equity has been the main narrative this year so far. I think now with those mezzanine type of structures, hybrid capital that we're seeing, that's where it enters probably another more sophisticated period, the whole treasury space. And I think on the retail side, equity is still a bit easier to grasp, especially from a European perspective. I think in Europe, hybrid capital, mezzanine capital has been traditionally not as prominently placed as arguably in the States. Having said that, the oversubscription, or basically the increase of the stream product, I think in the last 2 weeks from I believe 350 million to 650 million, clearly shows that there's significant demand. And I think what Saylor is doing clearly is increasing this total addressable market, or establishing a new market where you have essentially a hybrid product, a mezzanine product with a Bitcoin exposure, yielding extremely high, or offering an extremely high coupon in what traditionally has been a very low yield, start for yield environment that Europe is. So I think we will see clearly an increase in demand for those type of products, also on the credit side, to basically optimize your debt to Bitcoin ratio, essentially be less dilutive to be able to stack more Bitcoin on your balance sheet.
Can I add on there real quick? What all of these companies are trying to do is identify the longest duration leverage with zero margin calls and zero of the negative benefits, zero maturity. So the advancement of this perpetual preferred equity is really appealing because there is no debt maturity. Any of the capital raised with perpetual preferred equity, they do not have to pay back. Let me say that again. Any capital raised with perpetual preferred equity, they do not have to pay back. Any debt capital that they raise, they have a maturity. They have to pay it back. So that's really appealing when you have a stack of collateral that's incredibly volatile. How can I create leverage or amplification where I don't have to pay it back? And equity, the form of equity, does that.
Yeah, thank you. Sander, I was going to ask you, can you explain why Bitcoin is a long duration asset? And can you explain what happens when there's a mismatch, like a duration mismatch between your assets and your liabilities? And can you explain why Bitcoin Treasury companies want to prevent that mismatch?
I think you just have to look into the history and see how volatile Bitcoin has been, but it's always been volatile up to the right. And when you try now to structure credit, you have to think about the volatility of the asset itself. So what we have seen in the beginning of this Bitcoin Treasury bull run earlier this year was copying Michael Saylor's convertible bonds, which was basically most of the companies they raised for 5-year duration, 0% interest rates. They raised in fiat, but you also saw companies coming into the market with Bitcoin-denominated convertibles, which basically doesn't put you in a risk of returning back your fiat, but in a situation there you have to repay the same amount of Bitcoin. So it's super important for these Bitcoin treasury companies to understand the risk of the debt you're taking on and the liabilities you actually have to manage over time. And I think what we see now in the industry, especially with Michael Saylor first and then Jeff in Strive, they're launching new products that are actually fitting the long duration of the asset class we try to capitalize on and give more exposure to investors worldwide.
Yeah. I want to talk about the benefits of digital credit. And Saylor mentioned a few, and maybe you can all elaborate on those. But he mentioned that dividends could be a shock absorber. Maybe we can elaborate on that. And also, can you explain how unique it is that you can create credit instantly versus traditionally you have to find somebody who you can lend money from and you have to deal out terms and conditions. So maybe you all three can elaborate on those benefits from digital credit versus traditional credit.
Yeah, I could start. So digital credit is an amazing phenomenon. Again, it's the same concept. If you're taking this really volatile asset and you're converting it into a credit instrument that's appealing to the credit market. The credit market is the largest pool of capital on the planet aside from real estate. It's hundreds of trillions of dollars large, and a lot of the bonds and the traditional fixed income and the credit products that are in the market are under-collateralized. They're very opaque risk. They're difficult to quantify. The private credit market's pretty big. And now you have these new instruments that are novel, that are paying a significantly higher yield than the rest of the fixed income market. And they're backed by sound money with Bitcoin. They're over-collateralized by sound money. And it's hard for people to conceptualize, but when you actually step back and you look at the risk of these instruments relative to other fixed income products, they're the relative risk is significantly better and the yield is higher. And that's incredibly appealing. And you hit on another really important part here is the access to that capital very quickly. So you think about the Strategy or our company Strive on the horizon here. Strategy has an ATM instrument on every one of their fixed income products or their perpetual preferred equities. That means they can go raise capital at the click of a button. That is incredibly novel. Historically, if you wanted to go raise debt, like anybody that's gone and got a mortgage in this room, like think about how awful it was going to get a mortgage. Like it's a financial colonoscopy, right? And now they don't have to go through that process. They can do it at the click of a button. And that is vastly overlooked about how valuable that is. So you look at, again, a company like Strategy, they're able to raise capital in stressed environments, which they weren't able to do previously. So that's a huge advancement in this marketplace.
Garry, something to add?
Yeah, so digital credit, I think, is going to rewrite the way we can capitalize companies that have essentially their main motive is somewhat of a accretive accumulation of Bitcoin, increasing their Bitcoin stack, changing their Bitcoin to debt ratio. If we're going to talk about specific European markets, I don't know if you want me to touch upon this or maybe later. I think Germany, for example, has traditionally been a very interesting market for private corporate debt. We call them Schuldscheine. And the investor is fairly familiar with this type of product. A lot of long duration funds, mutual funds, insurance funds, pension funds, they love investing in those type of deals or instruments due to the very clear cash flow expectation. Here we're now entering a new or it's a fairly big paradigm shift with Saylor leading the way, at least in Europe, in my opinion, with this mezzanine type of hybrid capital, where of course the coupon is not necessarily fixed but floatable, and he managed to do a prospectus for that, which is something that is not very accessible to many issuers, and we don't have as many seasoned issuers here in Europe as we do in the States. So you can, if you actually want to, also offer this type of hybrid capital, mezzanine capital, at least in Germany, without a prospectus. So it's the entry barriers are much lower. The downside is though that those type of assets don't become easily tradable on an exchange. So that's, I think, a small difference to other markets. But again, a fantastic product for someone that wants to have a high yield product with arguably a wrong rating. I don't think this product has been, we've chatted offline about this, should have a B- rating. But, Saylor's saying it's baby steps. That's step one, and then we'll see where it goes in the future.
Yeah, before we gonna dive into that rating, Sander, what do you think about the terminology of amplification? Does it confuse people that we use amplification instead of leverage, or is it necessary because it's so novel and it's something else, so we have to address that with another word? What's your opinion?
I think what we are seeing now is that the traditional financial industry is now understanding what Bitcoin is worth. And there we see like new terminology coming into the industry. It might not be so easy to understand, but I want to put it very clear to people that have been in Bitcoin early. You have done a great job. Now the full traditional industry globally recognize Bitcoin as something they're willing to lend against. And that's fantastic. That's a huge step for Bitcoin adoption globally. And when we speak about these technicalities around how to do it and in traditional finance, why they leverage these Bitcoin treasury companies, what it really means is that we have given Bitcoin value and people are willing to lend you money against the collateral. And the collateral is global. So when you have this collateral, you can lend from everywhere in the world, which is super unique to Bitcoin. And that's the asset class, which that's the reason why I think this asset class is going to grow faster than any other asset class. So I didn't answer your question, but I think it's important for the Bitcoiners to understand why we are talking about credit against the Bitcoin, because Bitcoin has succeeded. That's the reason.
Yeah, so an applause for all the Bitcoiners who were there for 10 years. All right. So the rating.
Can I take that
Yeah,
question for
yeah.
a second? I think the term amplification is completely necessary. As I mentioned earlier, the perpetual preferred equity is not debt. Strive has zero debt. We do not have debt on our balance sheet. We just raised $150 million to buy Bitcoin without a debt maturity. So amplification, I think, is incredibly necessary. And then also to hit on this last point too, the risk is, you can calculate the risk 24/7, 365. You cannot do that with any other fixed income product. Like, go think about like quantifying the risk on the fourth tranche of mezzanine debt on the Boeing balance sheet, right? Like, okay, you got to go look at the entire business model, the entire capital structure, who's senior to you, understand like how much revenue, you know, it's just incredibly complicated. But now you can see it 24/7, 365 on a website, and you can mathematically calculate it. That is an incredible innovation that hasn't existed before.
Yeah, absolutely. So back to the credit rating. Congratulations, Strive, on the issuance of SEDA. It's a competitor to Stretch.
Complementary.
Sorry?
It complements.
Complementary, yes, of course. So I want to, yeah, so the credit rating. In the presentation, I watched the presentation, and you told that Strive has set aside the amount of dollars for 1 year dividend payment. Was that like the original idea, or helped the report of S&P as a guideline for treasury companies to, yeah, to maybe structure it a bit different to get better credit ratings in the future?
Yeah, that's a great question. So our new perpetual preferred equity product, SATA, S-A-T-A, just started trading on Monday. We set aside 12 months of dividends or 12 months of dividends in cash to pay the dividends for the first year, or you know, however it comes up. But I think conceptually, some of the feedback in the market was to strategy was how are they going to pay the dividends? The reality is they could use the common stock ATM, they could sell covered calls, they could do 5,000 other things before they sell the Bitcoin, if they had to sell the Bitcoin, and it would still make sense. So for us, it was about increasing the credit quality, accessing these debt markets as a new issuer, which is a bit more challenging compared to strategy, who's got $60 billion of debt on their balance sheet. So, ultimately, having multiple issuers in the market is going to be helpful to go get credit ratings. But one interesting thing is the S&P actually, they knocked strategy for their credit rating because they held convertible debt on the balance sheet. In fact, the perpetual preferred equity was less of an issue because if you look at the calculus, strategy has 100 years of dividend collateral based on their Bitcoin collateral. Strive, we have 30 to 40 years of dividend payments based on the Bitcoin held on our balance sheet. Again, go compare that to other junk bonds in the credit market, and you will be fascinated at how under-collateralized many of these other credit instruments are in many pension funds and other ETFs.
Yeah, so this is a great segue into my next question. Saylor compared Stretch to a bank account, but let us inverse that and let us compare a savings account as a credit instrument. And what happens there? Because the yield is different, the amount of collateral is different, and the kind of collateral is different. And how will that impact stuff? Garry, you want to take this?
Well, first of all, I want to say, if we compare it to a bank account, you're essentially shorting fiat, right, with any debt-like instrument. And we absolutely need to do this more, especially in Europe. So I think with those type of products, we can, increase our Bitcoin exposure and short fiat more. And God knows, Euro needs some more shorting. versus Bitcoin. And other than that, I think, it could work as a nice retail type of focused product where you compare a savings. You get your 200 basis points, 2% savings accounts if you're lucky in Germany. So compare that to Stream. That's a nice 10% premium on top of what essentially is a almost non-real yielding bank account. So I think if the marketing works right, and I think we as an industry need to work a bit more on that, this will absolutely take over the continent.
Yeah, because now we're talking about yield, but like a bank has like 10% collateral, and we're talking about 6 times or 4 times. And the kind is different because the Bitcoin treasury companies have Bitcoin and not dollars or government bonds. I mean, risk is mispriced here, right?
Yes.
All right. So we're going to my favorite question, or I want to get your thoughts on this. So it came out to me that Bitcoin is sniffing out inefficiencies all over the world. So Bitcoin miners, they sniff out inefficiency in energy markets. They look for stranded energy. Then we look at payments, like Square just announced that they're gonna that all the merchants you can accept Bitcoin, and I think the dollar value goes on Bitcoin rails, so they pay 0 fee. So they're sniffing out inefficiency in the payment. I think Bitcoin treasury companies are sniffing out inefficiencies in the capital markets and maybe exposes all the mispricing and risk. So what are your thoughts on that?
Yeah, I could start. I absolutely agree with you. I think really I see personally Bitcoin treasury companies as cleaners of the capital market because think about it, right? We just went to go raise capital. We raised $150 million of debt-like capital from the market. That's $150 million that's not going to go to somebody else. And that can continue to happen as these companies that are over-collateralized go to access these different pools of capital. And so the businesses that maybe shouldn't have existed previously that have raised debt capital may not have access to the capital markets. And as the world starts to reprice this risk and put their head and grasp the mathematical risk of these things, that should reform the incentives of the capital market and how companies can access capital. So I completely agree with you.
Yeah, so we have 1 minute left. Sander, do you want to give some closing remarks?
No, I think what not other than Bitcoin treasury companies are building the Bitcoin capital markets. I think you mentioned payments, you mentioned credit, but I also think that we will soon see a more Bitcoin native capital markets with tokenization coming, and that will basically and Bitcoin treasury companies will see these kind of activities and help us unify around one global capital markets, which will be built on Bitcoin.
Garry?
Yeah, so I think we need to do definitely way more education, both on the retail and institutional side, seeing a full room of people interested in what essentially is a fairly highly complex structured product is unimaginable in a TradFi world. So props to everyone being here and listening to basically what will be the future of financial markets.
Right, Jeff?
I came for number go up, and I'm staying here to take over the debt market.
All right, so enjoy the bitterballen this afternoon.